Booyah! Welcome, folks, to the biggest fight on Wall Street since, well, ever. Forget everything you think you know about making money. We're talking about a heavyweight championship bout for the ages. In one corner, you have the seasoned pro, the Wall Street veteran with decades of experience, the gut-feeling genius who can smell a winner from a mile away. We're talking about the human hedge fund manager, a real person with a real brain, making real decisions with your money. They've been running the show forever, and they've made a lot of people very, very rich. They are the kings of the castle, the masters of the universe. They go to the fancy dinners, they read the Wall Street Journal, they make the big calls. But hold on, in the other corner we've got the challenger, the new kid on the block. It doesn't sleep, it doesn't eat, it doesn't get emotional when the market tanks. It's a machine, a thinking machine. We're talking about artificial intelligence, AI. These are the new quant funds, robo-advisors on steroids. They use complex algorithms, mountains of data, lightning-fast computers to make trades faster than any human ever could. All right, let's break it down. An AI hedge fund. It sounds complicated, like something out of a sci-fi movie. But it's simpler than you think. Imagine a brilliant analyst who has read every financial report, every news article, every tweet, every government document ever created, all at once. Now imagine this analyst can look at all that information, find hidden patterns no human could ever spot, and then make a trade in less than a blink of an eye. That, my friends, is an AI hedge fund. It's not a robot sitting at a desk smoking a cigar. It's a powerful computer program, an algorithm, designed to do one thing and one thing only: devour data and spit out profitable trades. These machines are data-hungry monsters. They don't just look at stock prices and earnings reports. No, that's child's play. They analyze satellite images of parking lots to see how busy Walmart is. They scan social media sentiment to see if people are excited about the new iPhone. They look at weather patterns to predict crop yields. They're looking for an edge, any tiny little piece of information that can give them a clue about which way a stock is going to move. Now let's not count out the humans just yet. The traditional hedge fund manager is the classic Wall Street archetype for a reason. These are the legends, the storytellers, the people who built this industry from the ground up. Think of a manager like Peter Lynch or Warren Buffett. These guys didn't have supercomputers. They had brains, guts, and an incredible ability to understand a business. A human-managed fund is built on a foundation of experience, intuition, and deep, fundamental research. These managers don't just look at numbers on a screen, they look into the soul of a company. They are the grand masters of the game. How do they do it? It's all about the human connection. The human manager will fly out and meet with the CEO of a company. They'll walk the factory floor. They'll talk to customers and suppliers. They want to know, is the leadership team smart and trustworthy? Is the company's product something people actually want? Is there a long-term vision that makes sense? This is the kind of qualitative, on-the-ground research that a machine just can't do. All right, talk is cheap. Let's look at the numbers. Let's go to the tape. This is where things get really interesting. For years, the story was that these newfangled AI funds were going to crush the old guard. And in some ways they did. The raw data is a mixed bag, and it tells a shocking story. Some studies show that over certain periods, especially in choppy sideways markets, AI funds have delivered more consistent, stable returns. They grind out small wins and avoid big losses. Masters of risk management. For example, a report from Eureka Hedge showed AI-driven hedge funds often outperformed the average hedge fund index, especially during times of high volatility. Think back to the market chaos in early 2020. While many human managers panicked, some AI systems navigated the storm with less damage. They don't panic sell. They see patterns and react. This consistency is a huge selling point. They're like a reliable utility player. They might not hit the most home runs, but they get on base every single time. But here's the twist. In a full-blown bull run, when everything is going up, humans often come out on top. Let's name some names. When you look at the biggest and most famous hedge funds in the world, you see this battle playing out in real time. On the AI side, the undisputed king is Renaissance Technologies and its legendary Medallion Fund. This place is more like a top-secret MIT lab than a hedge fund. It was founded by Jim Simons, a brilliant code-breaking mathematician. They don't hire Wall Street MBAs, they hire PhDs in physics, astronomy, and computer science. They famously don't even care what a company does, they just look for statistical signals in the noise, pure quantitative voodoo. On the other side of the ring you have a giant like Bridgewater Associates, founded by the legendary Ray Dalio. Dalio built his firm on radical transparency and a set of principles for life and work. They do deep, fundamental macroeconomic research, very human-driven. But they also use powerful computer algorithms to test their theories and manage risk. Dalio calls it the man and model approach. And then you have a firm like Citadel, run by Ken Griffin. They have teams of traditional human portfolio managers making big conviction-driven bets. But they also have one of the most powerful and sophisticated quantitative trading and high-frequency trading operations on the planet. They are playing both sides of the field at the highest level. These titans aren't choosing one or the other, they're trying to weld them together into an unstoppable force. Let's talk about the risks. The AI funds sound amazing, right? No emotion lightning, fast, data-driven. What could possibly go wrong? Well, a lot. The biggest risk is something called black box risk. These models are so complex even their creators don't understand some trades. The AI finds a pattern, but programmers can't explain the logic. This is terrifying. If the AI starts losing a ton of money and you don't know why, how do you fix it? You're a passenger on a plane with a robot pilot flying into a mountain. Another huge problem is overfitting. Classic quant mistake, trained on historical data. It might find a strategy that would have worked perfectly for the last 10 years, but the future doesn't always look like the past. A new event, something the model has never seen before, like a global pandemic or a new kind of war, can come out of nowhere and completely break the model. This is what led to the famous quant quake of 2007, where many brilliant models all failed at the same time because market conditions shifted in a way they weren't prepared for. And don't forget the risk of crowding. As more and more funds use similar AI strategies and similar data sources, they can all start making the same trades at the same time. This is a recipe for disaster. It can cause a flash crash where the market plummets in minutes for no apparent reason, simply because all the machines rushed for the exit at once. The very efficiency of the AI becomes its greatest weakness. Alright, let's cut to the chase. Today, on September 17th, 2025, who is winning the war for your wallet? Who's making the big bucks? The shocking answer is both, and neither. I know, you want a clear winner. But the truth is, the line between AI fund and human fund is getting blurrier every single day. The smartest players on Wall Street are realizing that the real winner isn't man or machine. The winner is man with machine. It's the Centaur investor, a hybrid that combines the best of both worlds. The funds crushing it are using AI to empower human managers. Think of it like this, a human manager still comes up with the big idea. They do the deep research, they meet the management, they form a thesis. That's the art. Then they use AI as a superpowered analyst. The AI can scan millions of data points to confirm or deny the thesis. It can monitor investments for risks the human might miss. It can optimize the best time to buy or sell. The big money is flowing to these hybrid firms. A manager might say, I think retail spending will be strong this quarter. The AI instantly analyzes credit card data, satellite images of mall parking lots, social media traffic, and returns a probability score. You're 82% likely to be correct, and here are the 3 stocks that will benefit most. That's the new king of Wall Street. So what does this all mean for you? The home gamer, the person just trying to save for retirement, a kid's college education? It means everything. This battle between man and machine is changing investing, and you need to pay attention. The future is not about choosing a human fund or an AI fund, it's about understanding how any fund you invest in is using technology. Ask, what is your tech strategy? If they don't have a good answer, run for the hills. For the average person, this technological arms race is actually a good thing. It's leading to more options, lower fees, better tools. The rise of robo-advisors, simple algorithms managing portfolios, is a direct result. They offer sophisticated, diversified management for a fraction of traditional cost. Massive win for the little guy, democratizing tools once only for the ultra-rich. You can have a piece of that AI magic working for you. Looking ahead, integration gets deeper. The future is personalized, data-driven, powered by a human plus machine alliance. So, who wins? In the end, you win. Now go out there and make some money. Booyah!